Antoine Bouvet, who is the head of European Rates Strategy at ING, now joins in on the show. Thank you so much for taking time out. And it clearly seems this time around that a slower pace of tightening is going to be seen by the Federal Reserve, largely in light of the kind of headlines that have emerged on the back of the banking crisis. Does that seem to be the best case scenario?
Yes, I think 50 basis point hikes are pretty much off the table, given the doubts of how far this will spread to the real economy. But what we can say for sure is that absent further contagion, or not for sure, but our main view is that absent further contagion, the Fed will be in a position to continue hiking at this 25 basis point hike pace.
So that's about the hike and the pause. But what the market is, penciling in or wants to know is, when will the rate cut cycle begin? Are you in the camp as well that will happen in the second half of this year itself, or will it be towards the fag end of the year, or maybe just next year?
We're definitely the first camp. We think that the Fed will be in a position to cut rates later this year. In any case, we forecast inflation to fall relatively quickly in the second half of the year. That with an economic slowdown and now compounded with the difficulties in the banking industry, we think this will set the stage for the Fed to cut rates as early as the second half of this year.
Antoine, what is the outlook then going down the line when it comes to the entire banking sector as a whole? Given that, yes, rescue efforts have been taken to really mitigate the spillover effects or getting much worse, do you believe that this is, a signal of the kind of action that could be taken if there were to be the contagion effect of the banking sector spilling over?
The short answer is I don't know. There has been a pretty strong regulatory response, at least from the Fed, providing liquidity to banks. So I think there's less doubt now that should a deposit run happen to any bank, they will be in a position to pay the depositors back, and that in turn reduces the risk of a run on deposits. So that's the positive news. There's been also discussions overnight. Bloomberg reported that the Treasury is looking at a way to insure deposits temporarily, should this be the case. Above the FDIC $250,000 limit. So all this participates to this improvement in risk sentiment that you just talked about. Now, what's the outlook for the banking industry? At the very least, we'd expect that the higher funding cost and more challenging operating environment for regional banks will result in some degree of credit tightening beyond what was going to happen anyway with the tightening of the Fed's policy. And that in turn is something that is going to weigh on the economy, weigh on inflation, and allow the Fed to cut interest rates.
See the 10-year headed now, because it's been fairly volatile of rate from the start of the year of 2022, where it was at 1.5 level. It moved all the way to 4%, now back at 3.3 thereabouts, and actually moving around 3.5 at the moment. Where do you see them headed on a more sustainable basis? What's the range, do you believe?
Probably somewhere around 3.5 is the top, but like I said, I think the market is right in taking out some of the hikes that was priced by the curve, and this should result is also the peak of 10-year Treasuries yield being much lower post that banking crisis than before. So that's the first thing to say. And as for the bottom of this range, I still think 3% is a reasonable target for the end of the year.
3% for the end of the year. And tomorrow from the Fed commentary, are you looking forward to any particular area being addressed? Is there anything specific that you would want to hear from Jay Powell tomorrow?
Yes, I mean, so the first thing to look at is, of course, the forecasts sent by the FOMC. We're not expecting major changes, but this is something that's going to have implication for future policy moves. That's the first thing to look at. And secondly, I'm expecting Powell to draw a clear distinction between monetary policy decision, which is the reason why the Fed is still hiking. Inflation is and has remained above target for a long time. And financial stability decision, which is the decision that's been taken a little over a week ago to provide liquidity to banks, and last weekend to provide dollar funding for foreign through foreign institutions. So that's the distinction is valid, and I think this is something that the ECB also highlighted last week. The question is, to what extent will the market buy it? And I think the answer to that will depend on contagion risk. So for now, I think the Fed has a decent chance of managing that hike whilst acting on the liquidity front for banks.
And it's a busy week as well, Antoine, when it comes to the central banks. There are, you've also got the Bank of England, Taiwan, Brazil, etc. Just wanted to also get in your take then as to what the outlook is when it comes to global central bankers, in particular for the Eurozone as well. What's the outlook that you're expecting from the ECB?
Right. So I think I'm going to make a general statement that applies, generally speaking, to the whole central bank cycle globally. Of course, there are exceptions, but I think 2023 is still different from 2022 in the sense that in 2022, central banks, the Fed and ECB included, Bank of England as well, were catching up with inflation. They were behind the curve. They were hiking almost, in autopilot, hiking 50 or even 75 basis points at a meeting. Sometimes they was clearly motivated by the fact that their policy rate was too low compared to inflation and they needed to catch up. Now in 2023, policy rates are restrictive in much of the world. And so central banks can afford to take policy decisions, on a meeting by meeting basis, which means they're data dependent, which means that the size of the hikes will be smaller, which means that we're more likely to be closer to the end of the cycle, which means that it's going to be an environment that is less disruptive by financial markets, because in most cases, we think the peak is in inflation, and therefore there is a much narrower range of possibility for policy rates, and that's something that should in turn result in lower rates volatility and better performance by risk assets. On the ECB specifically, they are slightly behind the curve compared to other central banks, which means that we cannot exclude further hikes lasting into June. But what's happening in the Fed will certainly have repercussions also on the ECB. If the Fed stops its hiking cycle earlier, it's also possible that the ECB has to stop its hiking cycle earlier. This being said, I do think that the ECB is behind the curve and that there will be a convergence between dollar rates and euro rates.
Okay, Antoine, we'll let you go on that note. Thank you so much for joining ET Now today.